here's let's talk about setting some really important stuff now, stops and profits. And first, stops. As a general rule, we like to use about a 20 pip initial stop, but in the case of a very low volatile, low range currency pair, 15 pips is adequate, maybe even just 12 pips if it's really low. What we like to see is that the stop is below the low of the wave that we use to measure the pullback from in the case of a buy, and above the high of the wave that we use to measure the retracement from in the case of a sell. Here it is. Exactly what we're looking for. And as you can see, I got an example of how to place an initial stop for either a buy or a sell. Okay. And so what you do is the price rallies up here to point A, it drops. Here's our noble entry right here, 79% fib. We want our stop above point A. Okay. And then 15 to 20 pips depending on the volatility. And it drops. Here's our buy example, and it rallies from A up to B. Here's our noble entry right there at 79% because we've come into expected support. ADR has been met, London close, all that kind of thing. And stop goes below point A. Again, depending on the volatility, but 15 to 20 pips is about right. Okay. So again, we generally use about 15 pips, but if it's a low volatility pair, like maybe under 100 pips, 15 pips is generally adequate. Now, the other way around, it may be necessary to allow a bit bigger stop, maybe 25 pips or so, due because of the high volatility pair of a pair, or a pair that can really move a bit. Shirley had a trade the other day. It was pound yen, wasn't it, Shirley? You had 30 pips risk on that one, which was just right. And on pairs like that, of course, you can expect a bigger profit target too.
We'll show that one too.
Yeah. So, but in any event, no matter what stop you start with, but the idea is you want to get the risk out of these trades as soon as practical. And we're going to go over that next when we talk about trade management. Okay?